Good afternoon. Today I'm going to be talking about when is the right time to invest. It's a question as an advisor we are often asked by clients, and the answer, realistically speaking, depends on what you're trying to achieve. So let's have a look at some graphs here. I'm going to share the screen. Bear a second. You'll be able to see this shortly. Here we go. Right. Okay, so when is the right time to invest? Let me consider two things first of all. How would you feel about an investment that did what this one's doing here? Starting off reasonable and over time falling. I think most people would be a bit disappointed in that. They even want to consider moving to something else. So what about if we had an investment that did this instead? Starts off, goes down a little bit, then picks up again. That looks a little bit better. And overall, over a period, the scales are irrelevant really. There is a bit of gain there, and that's going to make most people more comfortable. But which timing is which, really? How do you know which is which? Then you look at another option here. How would you feel about that one? It falls quite a bit, then it picks up again, then it falls again, then it picks up again, then it falls again, then it picks up again, it falls again. This is actually what most investments do. Now, if you're able to pick a point where it's in its lowest points, around here, say, and then invest until it goes up and sell it again there and buy again there, if you can time it right, you'll make money on it. But the interesting thing is, let me overload those to show you how they look together. That's all three of those. Now, obviously, I've color coded to make it a little bit easier. You'll see the yellow line is actually the third one. And overall, it starts off at the same place as the blue line, but ends up better. And there's a reason for that. It's actually the same investment. It just depends on the time frame you pick. The blue line and the red line, this is actually 2008, when everything went wrong. The blue line is 2008, start of 2008, and it collapsed over time. The red line is 2009. And the yellow line is 2008 to 2009 combined. So you can see over that time frame, it's all about timing there. A massive fall in the yellow area there, drops down here, if you see my cursor there, falls down well below my major panic. But as you can see, over a 2-year period, basically got back to where it started. So the major disaster that happened corrected itself. And that's kind of where we are at the moment. The markets at the moment are very, very volatile, and we all know why. COVID-19, coronavirus, is affecting everything. Companies are not trading, so obviously they're not making profits, which means the markets are not going to invest in them. People are paying out and not getting income coming back in again. They're paying their staff, they're paying suppliers, but nobody's making any sales to compensate for that. So of course it's not a good time. But do we think this is going to last forever? Of course we don't. We don't know how long it will last. Hopefully not very much longer, and things will start to recover. And the recovery might take some time. But as you can see, there a 2-year window on the worst crash that most people can remember recovered. This one could be worse than that, of course, but it might take a little bit longer. But let's see what happened. If I take you a step further on that, look at the next graph. This is what's happened since that period. You've got section there A to B, which is the first year, 2008. Then you've got A to C where it recovered. And now look where we are now. Despite what everybody thinks, well, the last couple of months has gone kaput. The graph doesn't quite cover that period. You can see what happened afterwards. So if you're in that, if you're able to take advantage of the really, really low there, you'd have gained quite a bit over that time. And even now, we're no worse off than you started. So that shows you what happens even after a major crash. We've had another major crash now, so timing's about right. So I'm going to talk to you about time in the market versus timing in the market. So time in the market just means if you were in there and stayed in, you'd have been up here now until recently. Timing the market means you try to sell when you were there, buy when you were there, sell when you were there, buy when you were there, sell when you were there, buy when you were there, sell when you were there, buy. Every time it went up, you sold at the top. Every time it got to the bottom, you sold. you bought again, and it went round and round in a cycle. Very difficult to do, and obviously you need to really be watching the markets. And the danger of that is you miss the right days. So when's the right time to invest? Who knows? I can't tell where it's going to be. And this next graph just shows you the impact of time in the market comparing to timing the market. Now, it's genuine data from the FTSE All Share Index for a 30-year period. It's not up to date, unfortunately, but it gives you an idea. This just shows you what would happen if you missed the best 10 days in that period. So you were trying to time the market by buying and selling, but you got it wrong. You missed those 10 days. It's only 10 days out of 30 years, so it's not a very big percentage. The grey area shows you how your performance would have been. You see it's gone down a bit in the middle and gone up again and gone down. But this is for 100,000 invested in January 1986, June 1986, sorry. And then that would have been about 969,000 now if you'd done that. Well, obviously, not many people have caught that one. But if you'd have left your money in the market instead of taking it out and not missed those 10 best days, it would be almost double. Now that's, unless you were lucky to pull out before those falls and go back in at the best days, very difficult to do. So staying in the market clearly worked, but it's all about time, because as I showed you on the previous graphs, the short periods mean you could lose money. And that's what investment's about. That's why we always talk about investing for 5 years or more, because if you don't invest for 5 years or more, you could be subject to those falls and panic. And I've got a lovely graph to show that now. This is a cycle theory, I call this. As you see here on the left-hand side, the black line is the markets are falling. And then they start to recover, just like they have in the previous graphs. To start with, you're going to be a bit cautious. You're not going to want to put money in because it's only just falling. It might go down again, a bit panicky. And then things carry on going up, which is what happened in the many years after 2008. And people forgot that it fell, to be honest. They started to forget it falls. And they became quite optimistic. So they started to invest. And then their investments got up and up and up and up. And they got excited about it until they get to the point where they're delighted and over the moon with all their investments. The red zone is the danger zone, that triangle. Is it time to sell? Should you sell somewhere between excited and over the moon? Because what happens next, we all know it falls. It's fallen over a cliff in this case. So first of all, people stay in the market. They think they're okay. They start to worry a little bit, but don't worry. Then it starts falling rapidly and they get scared. And the next thing, they start to panic. And then they start selling because they're panicking. Until they get to the bottom of the market where the green triangle is, and they're quite miserable. If they've sold, they've lost money. If they haven't sold, they're panicking, they've lost money. But surely that might be the best time to actually buy again, because the prices are low. Because the market's going to repeat that cycle again. It's going to start going up, and you'll be optimistic, and then you'll be excited. You'll forget the fact it keeps falling, and then you'll go back to square one again. It'll fall off a cliff again. So unless you know when to buy and when to sell, it's far better just to ride out the roller coaster. Stay on the ride. Only sell when you physically want to sell. Don't be driven by the way the market is behaving, because it's going to change. It will change many times. The longer you're invested, the more you get used to that. It goes up and down, it goes up and down, it goes up and down. Sometimes it goes down a long way. Sometimes it goes up a long way. And over time, it generally climbs. The longer the period, the more likely it is overall to have grown. But it will up and down. So there is no right time to invest. Whenever somebody asks me what's the right time to invest, I always say now. Because I don't know what's going to happen tomorrow. I don't know what will happen next week. I can guess at some of that. I might be wrong, I might be right. But it doesn't really matter, because once it's invested, I can't really say, I'll take it out again the day after because that's the wrong day to be in, and go back in again. I'm not going to do that for you, because that's going to cost you a fortune in fees. And I'll be your permanent full-time advisor, and never dealing with anybody else. It'll just be you. So I'll be charging you my full charges for the whole year just for you. So it's not going to work. So I think that gives you something to think about. I'm going to stop there and take it from there.